The crypto market has been on a gigantic dumpster fire recently, and there's very high level of trading and sell-offs. In moments like those, it's very important to keep a leveled head and to make sure that you get the best deal out of any major market volatility episodes. Polygon Matic is a platform for structuring and scaling up operations based on the Ethereum network. The infrastructure is backed by two heavyweights in the industry that are Binance and Coinbase. There are several on-chain systems supporting the network like Polkadot, Cosmos, and Avalanche. The governance token is Matic, and it is the token that we will be talking about today. I mean, let's be honest, at the moment, things aren't necessarily looking great. The price of Polygon has increased by a significant margin over the past 12 months, so in terms of how much room there is to retrace, there can be some way to go still. With that being said, from a historical perspective, Matic coin is now nearing its historically low level, at the beginning of a massive bull run. And with that being said, I think that it'll be worth your while entering around 30 cents or even 50 cents level and the dollar average down from there. The sell-off pressure from the market is going to be significant going forward, partially because the market is still in the recovering phase from the sell-off. Actually, maybe even earlier than the recovering phase. It's still in the sell-off phase before recovering. Recently, the catalyst that really kickstarted the whole thing was the increase of the federal rate. This is also putting additional pressure on people's need for alternative investment options. But despite the fact that the market is in a degraded state at the moment, I think that we should still take a step back and to take a look at what is Polygon and whether it has a future in the world of crypto. And by that, we are assuming that crypto is going to continue to have a significant place in our economy and in the financial planning of market participants, may them be retail or institutional. I personally believe that Polygon Matic as a level 2 token based on the Ethereum does have its pertinence in the Ethereum network, and that there will be opportunities in the future where Ethereum begins to be proof by stake instead of proof by work. That would encourage a lot more activities to occur on the Ethereum instead of alternative networks. For instance, I think that off the top of my head, the ERC network is often the main option used by most exchanges when sending and receiving funds. The second one is usually Tron, followed by Binance. A lot of people are relatively uncomfortable with Tron because its founder tends to have some red flag behaviors, not unlike Do Kwon, the spokesperson of Luna Terra. So as we move forward, it's important to remember that very often people use alternative networks because Ethereum is so expensive. It doesn't mean that so many people are willing to drift away from it permanently. For now, I don't think that Polygon Matic is going to drift back to where it was back in 2019, but I am willing to believe that the correction may last for more than a couple of weeks, or even a couple of months. Nobody can say with certainty where the bottom is, and frankly, we shouldn't need to pinpoint the bottom in order to enter in Polygon Matic at a decent price. Personally, I think that the price of crypto is going to continue correcting down to around 20 cents before the holders start to think about re-entering in the market. I would also recommend to keep that position as a side one, without putting your entire portfolio in danger if extreme volatilities events occur again. I would recommend to commit between 5 to 10% of your crypto portfolio to Polygon Matic and to enter in the position in 10 batches or even more. When we trade cryptocurrencies, we should also keep in mind of the following aspects: the world events, the stability of the economies, the yields and the regulations of those exchanges and cryptocurrencies. So the first one is world events. Right now we know that things are not necessarily going well. And frankly, things haven't necessarily gone well for the past 2 decades or so. I mean, the 21st century so far is not exactly known for the peace. It's relatively peaceful if by that we mean there's no world war. But it doesn't mean that conflicts don't occur. And right now, those conflicts are really gripping the momentum of the market. So enough people are thinking that there may not be an economy, period. So we might as well just cashing out of the market and start either buying very safe investments, so corporate or even the federal treasury bonds, maybe to buy some gold coins and to stick them under a mattress. So these things that we used to joke about suddenly may not be that funny anymore. And this is why we have to think about the extent of the consequences of those events on our investments. The other thing is that at the current moment, one other thing to consider is the stability of economies around the world. When things are too stable or too good, such as 2016 to 2020, maybe not including 2020, but from let's say 2016 to 2019, the world probably didn't really need that much alternative investments because there were enough incentives to put your money in the stock market. Not to mention a lot of the projects that we're talking about today, including Polygon, they were still in their infancies. So in this kind of environment, when people don't necessarily feel the need to put their money elsewhere, we won't have a bull market in the alternative investments such as crypto or NFTs. But when things are a little bit bad, let's say when the interest rate is very low, when the stock market, for whatever reason, is sluggish, because after 10 plus years of massive bull market, at some point, they got to start retracing. So in those circumstances, people will put the money out of the financial markets and put it in the cryptos. So that is one end of the spectrum. The other end is things are sufficiently bad so that people start pulling out their money out of any investment and start stocking on the canned foods. This is unfortunately happening around some corners of the world. And of course, we should price that in as well. And right now, I would argue that the bull market of the 2020 was in great part neutralized by what's happening in early 2022, and which is still happening nowadays. I really thought that we were going to have some sort of ceasefire or the ending of the conflicts, but that didn't happen. And from where things are going now, we may be going for some prolonged period of slow and grinding conflicts instead. And this, of course, is going to put its weight on the market until it doesn't. And sometimes there's no additional reason for it. Like the market may have just priced in the event and moved on from there. This is also a real possibility. So we have to keep that in mind while trading any sort of assets, whether it's cryptocurrencies, NFTs, bonds, stocks, gold coins, whatever. So we have to keep in mind of those events. Another element would be the yields and the regulations. They kind of go hands in hands, but not always. So first of all, the yields. Ultimately, a yield means how much money you're getting back for your investment. This can be the dividend yield, this can be your capital gains, this can be the crypto staking yield. So whatever the form is, the substance remains the same. When you put in investment, you're expecting to see some profits, right? So the proof by stake cryptocurrencies so far have served that purpose. A lot of people are buying cryptocurrencies just to hold them and to eat up the interest rate. This has been great, especially with some platforms like KuCoin and its interest rates with lending that went through the roof in the beginning of the year. But then things kind of went downhill from there. And I'm not even talking about the recent sell-off. I was referring to how the interest rates for many DeFi platforms and for many cryptocurrencies, they simply just decreased. Maybe this is the normal way of going, in a sense that before we were either benefiting from not enough people participating in those pools, or the fact that those platforms were promoting their options or their services so that you will put your funds in on their platform. And this is why we were benefiting from like 12 to 20 to 30% of interest rates. And this may not be the real rate, right? We know that Anchor protocol is not going to be able to sustain a 20% interest rate per year. So we really have to keep that in mind as we go forward. Which, by the way, since we're talking about Polygon Matic, Polygon is based off Ethereum, and the DeFis on Ethereum, they tend to have relatively lower staking rate. I don't know if it's because on a collective basis, the DeFis or the exchanges on other networks, for example, BSC, they were trying to hook people on their own networks. Is that the reason why the interest rates are significantly higher there? No one will know for sure, but like, this is plain to see. Obviously. The other thing is the regulations. I think that from now on, there will be increasing scrutiny and regulations, or at least regulatory attempts towards the cryptocurrencies by the governments around the world. They've been waiting for this opportunity, and I think that right now they're going to dig in finally. So there is a lot of moving pieces that are probably going to be set in motion as we go forward. For now, the main things to concentrate on are, first of all, are those volatilities going to die down? If so, what's going to happen next? I personally think that for some of those networks, it may be over, like the best days may be behind us. But for others, Ethereum namely, things may not look as bleak as they are now. Thank you very much for watching. If you like my stuff, please like, comment, and subscribe to my channel.